Financially, the year 2022 was tough. The market crash, geopolitical uncertainty, and sharp rate hikes led to global economic turmoil. Costlier gas prices and groceries made it harder for many people to put money into savings. Amidst all the noise, many people ended guessing and second-guessing their financial decisions, and it only ended up adding more layers of complexity, which made managing finances more challenging than it's been in previous years. Looking ahead to 2023, major economies are expected to slow down further and even experience mild and shallow recessions, so we can expect 2023 to throw its fair share of challenges in managing our personal finances. But a beginning of a new year can mean a fresh start, and it's the perfect time to review your financial situation to improve your day-to-day finances and avoid any challenges many of us experience with our spending, saving, and debt despite our best intentions. After all, good financial management will save you time, money, and stress, helping you prioritize expenditures, make informed decisions, and effectively allocate resources. So, whether your financial goal is buying your first property, or saving for your dream holiday or hitting early retirement, it's imperative that you lay the foundation for financial success by adopting some time-tested principles and stick with them. Before we proceed, if you've enjoyed the video so far, do consider subscribing to our channel ATLAM, where we discuss all things life and money. We're constantly working to upload such informative and educational videos to help you guys better your lives. Number 1. Review your assets and liabilities. In order to make any positive change in your financial life, it's essential to understand the current state of your finances and create a realistic financial strategy for the year ahead. Start with a comprehensive assessment of your assets and liabilities, followed by an evaluation of specific financial goals. Make sure that each goal is measurable and attainable, so you can be aware of how much progress you're making towards achieving your goals. This may seem boring, but it's an important step to understand what you have and what you owe for a financially successful life. Gather statements from your bank accounts and retirement portfolios, as well as valuables that you own such as investments, real estate, or even cars. Review them, analyze them, and create a plan based off this information, so that you can start saving more money each month or build up your investment portfolio. Once you've taken the steps necessary to gain clarity with your current financial picture, it's time to think about what you want to do with this knowledge. You'll want to ask yourself if you're on track with your dreams and goals. Also, figure out how to make adjustments as per the prevailing market conditions and by planning to reduce your debt burden. Number 2. Budget. If you haven't been budgeting till date, now is the time to get started. Setting up a budget will help in saving for a major goal and achieve your financial goals faster. For many people, the 50-30-20 rule is a great solution. Budgeting doesn't have to be complicated if we can divide our income into 3 simple categories. 50% on needs, such as your rent, bills, and financial support to loved ones. 30% on wants, such as going to bars and restaurants, paying for an upgraded laptop, and having a Netflix subscription. And 20% on savings or paying off debt. By dividing your income into 3 segments, you're better able to identify how much you can spend on consumable items and save for the future. For instance, it's so easy to allocate something as simple as 20% of our income each month into savings or paying down debt. But it's all about the small changes that we make, because those little decisions have a huge impact in the long run. Of course, these percentages aren't set in stone for everybody, and you can adapt them to meet your particular circumstances. But these general parameters can give you an idea of how to tweak your spending to allow you to meet your target for savings. If you're currently spending too much on wants, for example, you might try cutting down how many takeaways you order per month, or put a streaming subscription on pause. Number 3, managing your debt. Interest rates have gone up over the past year, and it seems like it will continue to rise into 2023. This will make the cost of borrowing more expensive across mortgages, other loans, and credit cards. So, before you focus on your saving, look at any debts you have. Why? Because the interest you end up paying for, let's say, a student loan or auto loan or credit card is relatively more than any interest you gain from a savings account. So, review your debt portfolio to identify and clear off debts with the highest interest rates. While debt in general is bad, credit card debts is one of the trickiest to tackle as it typically comes with high interest rates. If possible, try to consolidate your credit card debt and transfer any existing balances to cards that offer lower rates. The bottom line is, whether by debt restructuring or consolidation, you need to reduce your debt, as it will help you save more and invest it wisely for wealth creation. Having said that, not all debts are bad. there are exceptions. A fixed rate mortgage can be a good debt, both for the tax write-off and the security of knowing that you're building equity. Number 4, build an emergency fund. Building an emergency fund can be very challenging, but nonetheless, it's necessary as it is the first line of defense against unexpected expenses. It acts as a safety net of financial cushion for you and helps you maintain your financial stability in uncertain times like a medical emergency, a sudden need to travel, or repairing your roof. In short, providing you protection from a necessary debt. Deciding on how much money to put in your emergency fund is a matter of determining what kind of cover you need from a monetary perspective. Typically, 3 to 6 months emergency fund should be sufficient to get you through difficult times. But since we've been facing an economic downturn for almost a year, it'd be better if you go ahead and stash away 12 months worth to help you weather any storm with less stress on your long-term goals. Number 5, stop buying on impulse. Be it a purchase of $5 or $500, impulse buying can put a heavy dent in your wallet. If you're guilty of pulling out your credit card far too often, maybe you should consider setting a purchase limit to help you wait a certain amount of time before you buy something. For example, let's say you have the urge to buy the latest Nike sneakers, which cost about $150. You could set a limit on buying by telling yourself that you'll wait a week before buying that item. If that week passes and you still have that urge, then buy it. That said, there's a good chance you'll realize that you don't really need those sneakers. If a week seems extreme, you could consider setting a 24 to 48 hour rule instead. Now, you can also further solidify your purchase limits by understanding your impulse buying pattern. For example, if you often overspend on food and beverages when visiting the supermarket, it'd be wiser to eat a proper meal or some heavy snack before your visit. Studies have proven that this way you have more control on your purchases and end up spending less. These little changes may seem small, but will have a significant impact by the end of the year. If you want to be a financially successful person, now is the time to get serious about tracking your budget, saving more money, spending habits, and understanding the types of debt that you have. Don't forget that when it comes to your finances, every little bit helps. If you found today's video informative and helpful, do subscribe to our channel for more content like this. Thank you for watching this video. Hope you have a lovely day and a financially successful 2023.